Hi there, Shingirai here again with just another update on global economic data. The joint effort has seemed to be a recurring theme for a data-sensitive approach from major central banks, and this has somewhat limited the chances of further meaningful deceleration in underlying global economic growth. This has led investors on the market to speculate that perhaps we could have a lead to a bounce in Q2 to Q4 2019. In the US, S&P closed at 2,907 on Friday, and this was 0.51% up. Financials led the upward rally to the greatest extent, whilst healthcare experienced some weakness. 10-year treasuries closed at 2.57% amid increasing inflation expectations, and this would partially be stemming from a tight labor market exerting inflationary pressure on CPI. In terms of volatility, the VIX closed at 12.46, and this has left volatility in the weekly trading. The broad dollar index indicated a dollar which was weaker against developing and emerging country currencies. Some members of the Fed have argued for a tightening of monetary policy towards the end of 2019, but however, the market seems to be of the general consensus of a stable rate going through Q2 and Q3 2019. Events this week: market PMI data, industrial production and retail sales information would be coming out, so that's something that we would be looking out for. In Europe last week, the Euro Stoxx closed at 3,450, and this was led by a rally in the four largest economy indices going up, with France leading the pace at going up by 1.4% and Spain the slowest at 0.3% up in USD terms. The German 10-year bond was up by 5 basis points to close at 0.06%, steepening the yield curve. ECB, of course, led the base rates unchanged and committed to being ready to provide an appropriate amount of monetary stimulus as long as necessary. Events this week: final March year-on-year PMI figures will be coming out for the EU region, UK jobs report, inflation metrics, and retail sales statistics. Moving our attention over to Asia Pacific. Last week, the Hang Seng China Enterprise Index closed at 11,641, which is 0.2% down. Nikkei closed at 22,169, where the 10-year Japanese government bond remained constant at 0.03%. Thai, South Korean, and Philippine indices all produced a positive return in USD, whilst Bangladesh, China, and Malaysia counterparts experienced somewhat more of a lagged performance. Data coming off China has confirmed that domestic growth has stabilized and may be on the brink of an upward cyclical bounce. M2 money supply in China grew by 0.6 percentage points to 8.6% year-on-year as demand for corporate credit rose, and exports grew by 14.2% year-on-year in March, and imports were down 7.6%. The result of this will be a positive trade surplus, but CPI was at 2.3%, and this was due to increasing prices of pork. India CPI was 2.9% year-on-year, food inflation 0.7% year-on-year due to meat and fish prices. The absence of really any benign inflationary pressures may allow for the RBI to implement another base rate cut going into the further year. Moving our attention to Latin America, last week, Brazilian markets really under-delivered, which was the great performer last year in 2018 at minus 4.5% in USD terms. The new central bank autonomy bill has gone to Congress, meaning that the governor and deputy governor's terms would not necessarily coincide with presidential terms. In Mexico, industrial production was down 0.8% year-on-year in February, whilst markets gained 1% in USD, and Mexico base rate maintained itself constant at 8.25%.